Good morning, everybody. How are we doing on this beautiful Thursday? I will tell you on a personal note, I've been married, 3 weeks? I stopped going to the gym the week before the wedding because we had so much stuff going on. It has been a month since I've been out of the gym. I weigh the heaviest I've ever been. My stomach is now starting to roll over my pants. And I went to the gym for the first time this morning. And I couldn't even get through my warm up without huffing and puffing. So, public service announcement, you lose it very, very fast. It sucks. It's going to take me probably about 2-3 weeks to get back to where I was. I cannot believe you can spend years in the gym and 3 weeks later, it is all gone. So that sucks from a personal perspective. Not happy. When I got my accounting degree, Cal State San Marcos, back in the early 2000s, I had a couple teachers that had gone through the gamut. What I mean by that is they went and worked for an audit firm. They worked for a CPA firm. They sat on the boards of companies. They had seen it all. They really had gone all around. And at the end of their career, they were winding down, about to do retirement, and they decided to teach for a little bit at the colleges. And I had two teachers that I really, really loved out of my time there at Cal State. And they just were good people. And they would sit down and just level with you and say, hey, this sucks, but you got to do it. Or this is great. And this is the avenue I would do if I had to redo life again. They had all kinds of good ideas, and I really liked working with them. And I'll never forget that one of them, I wanted to say her name was Susan. Don't quote me on that. She said, Aaron, out of all the financial paperwork I've looked at for all the publicly traded companies, I've only been able to read the balance sheet 100% 3 times. That's it. Just 3 little times out of the hundreds and hundreds of financial statements that she's looked at, which tells me that as much as accounting is a black and white world, there is so much gray in it that you can pretty much get away with anything if you just label it right and know where to, bob and weave. So with that, the other statement I loved when I went to Cal State San Marcos and I had a business degree and I didn't know what I want to do when it came to accounting, or it came to what part of business yet. I remember some guy running in and he goes, you're all accountants. And he turned around and walked away. And I went, whoa, what was that? And I was about to ask a question. Some other kid just blurted out. And he goes, why are we all accountants? And he goes, the best question in the world. If you want to be in business, you have to be an accounting major, because accounting is the language of business. And if you don't understand or speak the language of business, you have no business being in business. And he turned around and walked away. And right then and there, my young age, I went, I'm an accountant because I got to be able to speak the language. So with that being said, and for all the people that are listening to this, you're probably going to want to get on YouTube at some point in time and look. I have my sign company's financial statements right here for the month of June. And we're going to go through them. This is something that no one teaches you. This is something that no one does, because basically we're digging around in my underwear drawer. I'm showing you exactly the money, what's happening, what's going on. And I'm going to show you some of the things that I use to figure out where my company's at, where to strategically place my company in the future, and everything in between. So these are the paperwork we're going to go through. And I will tell you right now, if you email me, ac@aaronclippinger.com, I will send you these statements and show you how to walk through and go even further with this. So ac@aaronclippinger.com. First things first is the balance sheet. Now, you got to go back into your school days. Assets equal liabilities plus owner's equity. So that's the equation. Assets are on one side of the equal sign. Liabilities and owner's equity is on the other side of the equal sign. So what we're going to do is on the asset side, we're going to be looking at the simple stuff right at the beginning. Cash on hand, accounts receivable, what people owe us, inventory, that's the raw materials that we could turn around and sell technically. And then we're going to add up. And those are our current assets. Then we have work in process, prepaid expenses, prepaid taxes. Now think about that, prepaid taxes. Why is that an asset? Well, prepaid taxes are something that we have given the government ahead of time for something that could happen in the future. If it doesn't happen, the government owes us that money back. So prepaid taxes does go as an asset, and you're on the asset side. It's a positive. We could get money back. Loan to officer, that's me. I took a loan out. If you guys want to learn why I took a loan out, that's considered different ways of getting around taxes, tax shelters. That's a whole nother podcast. And then deferred tax asset, which we have a 0 on. That's something that we did years ago. I have not done it again. I'm not even going to bother explaining that. Then you have fixed assets. This is still on the asset side. Leasehold improvements. So we're still leasing our building. We don't own our building. but we've done improvements to it, which adds to the value of that building on the inside, value for us, value for the landlord. And so we can actually, the TI improvements, tenant improvements, we can actually build that out, put it on their asset side, and then appreciate it off our books. So it adds value to our company for what we did. Even though it's technically not ours, and at the end of the lease, it would be zeroed out. At the time that we did it, you can add value to your asset side. Machinery and equipment, furniture and fixtures, transportation equipment, data processing equipment. Now, I love this data processing equipment on the books, $275,000. Now, what is data processing equipment? Those are computers. That's software. That's en route. That's Flexi. That's, the servers, the firewall, our data storage on site. There's so much that goes into that. So that's a big number. And it's something that you could expense. I like to put on my asset books because the company looks bigger, because let's not lie, we have all these computers, we have all the storage. So why not put it on our balance sheet? I like this because another reason why is, that's $250,000. When you look at a bank and you're trying to get financing for the next big project or trying to buy a building, those numbers add up. And when the bank looks at it and says, okay, total assets on mine is $2,539,000. That's a big number. If you're to expense all these little things and your books look like you have $600,000 in assets, you're more of a liability. You could probably go under. If you're sitting with $2.5 million on your books, that's a bigger wheel that's spinning. And the banks are going to look at that and go, okay, they're not too big to fail. That's never the case, but it's going to be harder to stop that engine from producing. And so there's a lot of things that I know for tax purposes, you want to expense it right at the beginning, but data processing equipment, that's one I leave on the books and depreciate slowly. It's not tax advantages for me, but for me, trying to buy a building, trying to get loans, trying to go to the next level, get more crane trucks, that's a smart move on my part to keep it on the balance sheet. And then down the bottom, less accumulated depreciation. I'm still going to depreciate that. I'm still going to take my tax advantages, but I'm not going to do it at the speed of which most people would, just because I want it on my balance sheet. All right, down at the bottom here, we have goodwill, less amortization, security deposits, and then we have an allowance for doubtful accounts, and it's negative $10,000. We always do a certain amount of write-off because there is a possibility that we're not going to get those the AR to be completely paid in full, and so we want to show that on the books that, hey, we're not dumb. We do know that there's a possibility that this is not going to be full, so we have just a line item there. All right, that's the asset side. On the liability side, we have the typical stuff. Accounts payable, all the people that we owe money to. We have credit cards. About the end of the month, we got to pay those. We have advanced deposits. Now, why is an advanced deposit a liability? Well, what if the client cancels the work? We owe them their deposit back. So until we actually put that sign on the wall and turn it into revenue, it's considered a liability. So advanced deposits are definitely on the liability side. Accrued commissions. We owe commissions to our sales reps. That money's owed to them. It's not like we can just line item that out. So since it's owed to them, we're going to have to put it on the liability side until we pay that out. Then we can cross that off. Accrued vacation, and then sales tax payable, and then payroll. All right. Long-term liability. Ford Motor Credit. One of our trucks we're still making payments on. Buyout from the previous owners. We have a stock redemption, and we have goodwill. Now, we broke it out, goodwill and stock redemption, for tax purposes for the previous owner. Not going to get into that right now, but if you're looking to do a buy-sell agreement, again, you can email me at ac@aaronclippinger.com, and I can walk you through why we broke it out from stock redemption to goodwill. The total liabilities is there. And now, remember what we said at the beginning, assets equal liabilities plus owner's equity. So if liabilities was 1.8 million and our assets are 2.5 million, the difference is owner equity. That's the value that I have in hand, cash in my hand, so to speak. But if I stop this big machine from spinning, grabbed all the gears at once and stopped them, that's how much money is going to pop out at the very end once I pay all my debt and have all my assets come in. Okay. So that's the owner's equity. Balance sheet's not that much fun. You got to be aware of it because long term it has repercussions, especially when dealing with banks. More importantly is your income statement. Now, I'm sharing this month with you for a special reason. The special reason is we had a gigantic project run through our shop. Huge. $1 million project. I think it was 1.087, so just over $1 million. It took us a year to build this. So we were slowly building this big, gigantic project. And it was, if you guys were on any one of the forums or social medias, it was a 17-foot set of channel letters in Jacksonville, Florida. And big project. We had to take down the old set of the 14-foot tall letters, patch and paint the wall, which was about, God, I think 800 square feet, and both sides of the high rise, and then put our letters on it. Over the course of the year, this $1 million project, we ended up doing work in process, build some in December, some in January, a lot in February, a lot in March, and then shipped it out. Now, we can't recognize that as revenue until the project is 100% complete. So in March, we shipped it out. We had 400, 500,000 on the books as work in process, just sitting there collecting dust. Nothing we can do about it. It's on the asset side, so it's not like we took a hit, but I can't recognize as revenue because the project's not done. Once we got it there in March and April, Mother Nature took over. We had storms, we had wind, we couldn't put the signs on the wall. Then the install team that was supposed to be in there for 2 weeks had been there for 3 weeks. They said, hey, we can't push our clients off anymore. We need to leave. We're not going to be back for another 3 weeks. So the project went dormant for 3 weeks. Nothing against the install company. They were great. They were rock stars. Mother Nature just had other plans for us. So we went back in May, finished the project, put the last set of letters up, got it done. And then we had some touch-ups. We had some cleanups there. The swing stage had a little bit of damage to the building, so we had to clean that up. And in June, we finally closed this big behemoth project. And I got to take all the money from work in process, dump it into revenue against the expenses, and it hit our financials in June. So in this particular case, this project being a big one, it actually helped cover a little bit of our company because we had only closed out 220,000 on the other stuff. So it was a slow month for us normally. Historically, Integrated Signs does 400,000 out the back door, and we'd only done 220,000 out the back door this particular month. So it was a slow month for us. So our income statement in the way of revenue was 1.2 million. That's what we did for the month of June. Now our expenses was $989,000, $989,000 in expenses. That was all the materials, direct charges, subcontract labor, overhead. And then we have a couple other things that we call cost of goods sold. This is part of what it takes to build a sign. You have your salesman's salary, you have commission, payroll taxes, fuel expense, licenses, mileage expense, repair and maintenance, small tools, shop supplies, vehicle maintenance, vehicle registration, warranty, sales samples, and shop improvements. Long list, I know. But in my mind, the way I did my books was, if the sign company never produced a sign, none of these bills would come to fruition. I would never have that bill. So in my mind, that's cost of goods sold. Only when the wheel is spinning and signs are being produced, these expenses show up. If I never built a sign, would I have salesman's salary? No, I wouldn't. Would I have commission? No, I wouldn't. Would I have shop supplies? No signs being built. Why would I have shop supplies? So the top half, the cost of goods sold, in my mind, is bills that are only going to show up if I'm producing signage. So with that being said, that's my cost of goods sold. Now, we have other bills, right? How about we have bills that are going to show up no matter what? What's an example of one of those bills? How about your internet bill? The internet doesn't care how much you use it or don't use it, but it's going to show up, right? How about your cell phone bill? How about the mortgage? How about your water? How about your gas? Water and gas can be used, not to the extent of your building signs, but it's still going to be a bill each month. Those bills that show up no matter what are considered general overhead. And that phone is always ringing. I tell you what, I shut it off and it doesn't matter. There we go. Here we go. All right. So general overhead is bills that are going to show up no matter what. In my general overhead, I have clerical salary. I have project coordination, payroll taxes, payroll processing, accounting, amortization, bank charges, computer systems, depreciation, donations, dues and subscriptions, the snack machine, clothing, entertainment. Now the snack machine, let's back up on that one. Would any snacks be eaten if we weren't building any signs? Probably not, but it's hard to qualify a snack machine versus cost of goods sold for building a sign. So I dumped it on the general overhead. With that being said, is there an argument for both sides? 100% there is. So remember what we talked about at the beginning, is black and white as the accounting world is. There's lots of areas of gray. This is one of those areas of gray. I could take arguments for cost of goods sold top, but in my mind, that's a benefit So the snack machine, I'm going to put down as general overhead. All your insurances, for the most part, they're going to be due no matter how many signs you build. Let's see what we got here. Interest expense, legal expense, office supplies, marketing, janitorial service, postage and shipping, printing and reproductions, property taxes, rent, safety and training, telephone and travel. So that's general overhead. Now, in this particular case, since we aim, now you guys, this is another thing that's very important in your company. You guys have your expenses that's going up this way, and you have your revenue that's going up this way. And each piece of the signs towards that revenue have a little bit of your general overhead attached to it. It's a percentage. Inside of Square Coil Simple, it's just a percentage. You just type in a percentage there. If you use another software, pen and paper, you got to do the math calculations for it. But what it is your costs are this way, your revenue's this way, and there's that line that crosses right there. That's your break even. When those two lines cross, when it's your break even, then you got to figure out how much at break even, where I make zero money, does it cost me to run this in the general overhead? What are all those numbers come up to? For me, it's around, let's see, historically, it's around $98,000 to $102,000. That's what it costs me to run my company every month. In this particular case, since we had so much going on, a lot of extras going on for this big project, our operating expense for this month was $126,168. Now, this is very important, and this loses a lot of people, so I'm going to try my best on this one. When you overabsorb your overhead, so remember we have that break even, right? That X right in the middle of the X, that's a break even. What if you go past it? So remember our break even was $400,000 for integrated, but we did $1.2 million. So we went way past it. So in theory, we have all this overhead money that we captured that doesn't need to be applied to this month. We overabsorbed our overhead. Because you overabsorb your overhead, it gets added right to your bottom line. I know it's confusing, the world of accounting, I get it. But if you underabsorb, let's say you're supposed to hit 400,000, you only hit 350. You underabsorb your overhead, which means you owe more money than you collected for overhead. That means some of your profits have to go towards that overhead to cover it. I'm on the other side of the spectrum. I overabsorb my overhead, so the extra money that I captured for overhead doesn't need to be applied to overhead, so it goes right to my bottom line of pure profit. So in this particular case for the month, let's see here, a net profit for the month, we ended up with $288,000 for the month. Great month, right? Party. Woohoo! That's exciting. $250,000 in 1 month the company made. Wins, right? We all should be driving Lamborghinis. Or should we? This is where an owner needs to be paying attention. And this is where they need to be paying attention very, very closely. And I'm going to show you what to be looking for. Now, if you guys are running Square Coil software and have this, and you have the costing sheet and the closed project sheet, you have it with a click of a button, and then you can you can easily add that into QuickBooks, and then QuickBooks will pop out these income statements along with these charts. If you don't have Square Coil and you have to do this by hand, you can still get there, just a lot more energy, a lot more time. So this is what I do. I'll hold this up. Like I said, I've given you my email address. You can show this in a little bit. Hold this up right in the front here. This is every single month. I put them right next to each other, long form. Why do I do that? Because I want to see the differences. I want to see the percentage change. I do not care about the numbers. I care about the percentage change. If it goes up more than 5% or 3%, I want to know why. Why did it do that? What's happening there? Why is this, going up or going down? If it goes only 1% to 2%, that's normal. Each month doesn't really change, so I don't care about it. So I'm looking for percentage of changes and why did it happen? Is it a positive? Did we do something right so I can redo it? Or is it a negative and I need to learn? So I'm looking for percentage change on all of those. The other thing that I do that a lot of people don't do that I think is very, very smart. I'm going to hold this up again. Hopefully you can see it. I make a chart. And this one shows gross revenue, expenses, net profit. And I want to see the correlation between the two. Now, on this particular one, you see how this gigantic goes real steep, right? Very, very steep line of our profit margin. See how this one doesn't go as steep, more shallow? As an owner, what does that mean for you? Your revenue went up, but your profits didn't go up at the same level. Why is that? It's because you overloaded your shop. There's a law of diminishing returns. If you overload your shop and you push too much work through your shop in a given month, you're not going to get the same profit margins out of each of those projects. There are going to be errors. There's going to be mistakes. there's going to be things that you need to go back and change. And when you go back and change them, in turn, it's slowing you down. For every error, how much does it cost you? Let's say it's a $300 error. How much does it truly cost your books? It's multiple choice. Here we go. A, $300. B, $600. C, $900. Which one is it? If you said C, you're correct. Every error is 3x what it costs you. It costs you at the time of the error, $300. It costs you to fix it, another $300. And then it costed you the wasted time you could have been working on another project, $300. So it's $900 every single time. It's 3x whatever that error cost was. In this particular case, we had so much money go through the shop in the given time period that even though the revenue was very, very high, our profit margin went down a little bit. Now you're saying, Aaron, this took you a year. It wasn't through 1 month. What are you talking about? Well, that glutton of a project that went through, even though it took over months, took over other projects. And it became this big bog that went through the shop. Metal was overworked, then paint was overworked, then assembly was overworked. And because of that, we couldn't take care of our other customers. So their profit margins suffered and their quality suffered. And we had a little bit more errors on that one. So looking at this as an owner, would I take on this project again? Yes, I would. How would I handle it? Very differently. I would say this is going to be a 1.5 year long project. We're going to build a week, a month on this project to get it go through. And I would have put more time to my other clients because they're just as important. Just because one client all of a sudden has deep pockets for a second doesn't mean all my other clients don't matter. That's a common mistake. The owners are chasing the big dollar amount in the big projects because you think it's easy. One project, big dollar number is simple. It's not so much. In this particular case, I also learned something with the company too. 1.2 million is way too much to push for that shop inside of a given month. Now, 700,000, big difference. 700,000, I bet you my profit margins would have matched my revenue and they would have had that same trajectory versus this. And by having that same steepness of revenue to profits, because we wouldn't have had as much work go through the shop, we would have been able to pay attention to everything. That's just what I learned in the first 30 minutes of looking at the financial statement from June. Give me another hour or two of staring at this, and I bet you I can come up with even more stuff. Accounting has so many practical uses for it in the way of forecasting, what your shop can do, what it can't do, and everything in between. So as boring as accounting is, for me, super exciting. I absolutely love it because this is how I drive my company. This is how I direct them. This is how I say, hey, this is the avenue we want to take in the future because of the accounting world. That's why Square Coil is so heavily in the costing. Everybody look at it. Have you ever noticed that our software versus everybody else's is super deep in costing and accounting? Because this is the language of your company. This is the language of what you're doing. This is how you propel your company. It's not guts. It's not feels. There's true math and science behind the accounting papers that you get. So make sure you're getting your accounting on a timely basis. What I mean by that is 15 to 17 days past the first of the month. I feel really sorry for the companies that they closed their books in June, but they're still waiting for April financials. Months away. That's ridiculous. You should be working with your accounting department to make sure within 15 to 17 days, you have your report card of what happened the month before. I hope this helped you guys. Hope you guys are moving the needle on the bottom line. We'll talk to you next week.